A warm welcome back from the break. Over the next 30 minutes, my colleagues and I will take you through our wholesale business strategy. By way of my background, which Anand very kindly gave in his speech, I joined Piramal in May 2022, and last 1.5 years have been quite intense, but every minute of that intensity is something which I have really loved. Before joining Piramal, I worked at KKR and JP Morgan, where I ran similar businesses. We have an incredibly experienced and strong management team across various wholesale functions. I have with me on the stage Sandeep Agarwal, who's head of our credit and who comes with a lot of business experience in credit underwriting space across real estate and other industries. I also have with me Khudadat Pavri, or KP, who heads our asset management function, which, as he will explain, is the most important part of execution strategy at wholesale. We also have strong leadership across our origination coverage, and as you can see on the left-hand side of the screen, we have Shriram, who's joined us a few years back and who's responsible for managing origination coverage for South India. We have Satya and Vikash, who together run our West India part of the business. We also have Arpit Badhani, who recently joined to sort of build our small developer financing business, and which I'll talk about in a bit. But he brings a very interesting set of experience in that space. We have also built a specialist workout group, which we call as Value Enhancement Group, that focuses exclusively on workout and recoveries of distress or stress situations in our portfolio. And that group is led by Rohit Gupta, who comes with a lot of experience. So I'm really glad with the way the team has come along over the last few quarters, and we actually have a lot of expertise across different areas that we cover. Our strategic objectives for wholesale business are very clear. The first objective is to actually optimally run down 1.0 part of our business, or the old book, as we call it. But simultaneous to that, we also want to capitalize on what's going on in the market, particularly a big market gap that Anand alluded to in his speech that exists in wholesale lending space, and therefore build our new business, or 2.0 part of our business, as we call it. We believe that we have a significant right to win in this space, given our deep entrenchment and experience, and also that this business, if executed properly, which we are looking to do, will meaningfully add to our profitability of the firm. These are really the reasons why we want to rebuild our dominance in this space over the next few years to come. So where really we are at right now in our journey, as you could see on the charts here, we have made significant progress on monetizing 1.0 part of our portfolio. The old book stands now at 26,000 crore, which is 40% reduction that we have achieved over the last 5 quarters. We have got solid traction on our monetization efforts on this part of the book, and will continue this trajectory go forward over the following quarters. On our new business, we are at a fairly new stage of build-out. Today we have a book of 3,000 crore, which is between the real estate as well as corporate mid-market lending, or CMML, part of our strategies. The idea here is to build a book of 35 to 40,000 crore by FY28, which will be consistent with our target retail wholesale mix of 2/3, 1/3. Our expectation is that this business will generate 3.5% to 4% return on assets, and I'll touch upon how we get there as we go subsequent in this presentation. Let's take a closer look at what we have done in the 1.0 part of our business and where we are at. Today we have a wholesale book which is much less concentrated than ever. The top 10 accounts in our 1.0 book put together is down almost 50%. Today we also have not a single asset that is more than 5% of net worth of our balance sheet, versus 23 accounts just a couple of years ago. So we are much less concentrated is the key message I want to really leave you with this slide. You can see GNPA and NNPA ratios are down. The trajectory is good downwards, which we believe will continue. Stage 2 plus 3 assets in absolute terms, as well as a percent of AUM, are down meaningfully, and provisioning has normalized. This gives us confidence to say that our asset quality is now stabilized and credit costs have really normalized. Next slide. I'll spend a couple of minutes in talking about how we have been able to achieve this performance. And there is a long way to go still, but certainly worth taking a look at what's worked for us. Basically, I think that there are two things that we focused on. First, we have taken 1.0 recoveries as a separate project, dedicated project for which we have built a dedicated team under the leadership of Rohit. But also all of us have collectively spent a lot of time and efforts in managing this portfolio. But at the same time, we have implemented several strategies simultaneously as opposed to bringing down books piecemeal sequentially, and that has really helped. As you can see on the screen, we have generated a reduction of about 17,000 odd crore in the last 5 quarters. Of the 17,000 crore, about 64% has come from underlying asset cash flows and some situations where we have worked with our partners to get the refinancing done where new lenders step into our shoes but we exit, or recapitalizing the underlying project and SPVs through the promoters' contributions themselves or through new equity owners. This has been a lot of hard work, and I'm very glad to actually see the statistics here where more than 60% of recoveries have come through our partnerships and the performance of the underlying projects. About 8% came through a sale of an NPA portfolio to an ARC, which we concluded in the last quarter of last year. And it's worth noting that the cash consideration that we received was higher than the value of the underlying assets, net of provisions. We have done one more transaction, which concluded last week, and it's not part of these numbers, but the effort in this direction continues to go on. The third strategy that we have implemented for certain other stressed assets, where we believed selling for cash didn't make sense, as it would lead to a suboptimal outcome for us. There we have done 1585 structures with the ARCs, and that's what you see on our balance sheet, which I'll touch upon shortly, as the SR portfolio. 18% of our book reduction has come through this medium. And finally, in certain cases, we also undertook sale of the underlying projects and assets, which contributed 10% of the reduction. Talking in more details about the security receipts part of the portfolio, which is roughly 5,400 crore in size today. Out of this 5,400 crore, what wholesale accounts for is about 3,700 crore. Our strategy here will be to monetize these SRs systematically over the following quarters. We are deploying multiple strategies again simultaneously by way of achieving this objective. Like enforcing through NCLT and other creditor processes, liquidation of underlying collaterals through sales, or simply recapitalizing the projects. And we are making good progress in our liquidation effort and have already seen redemptions of 900 plus crore coming out of this portfolio. I also would say that at 63% markdown, we believe we have adequately provided for these SRs. Switching gears now to our 2.0 business, or the new business that we want to build. We believe it's a great time to build a granular and diversified wholesale lending business. We are building this business in 3 segments. The traditional real estate lending business, focusing on top 10 capital cities of the country, where we actually contract risk with mid-market developers in their residential projects, but also selectively commercial real estate projects. Small developer financing, which is an important strategy for us, as we believe we will actually see a lot of growth in this area, and I'll talk about this in more detail in just a while. And the third part of our strategy is building the CMML book, which is basically lending to middle market companies in the corporate lending space, which would add quite meaningfully to sectoral diversification of our book. What's really underpinning this opportunity, in our view, are 4 factors. First, that there is a much less competitive lending landscape now. Competitive intensity has gone down significantly because a number of our competitors have vacated this space. Anand also talked about the recent merger, HDFC Bank, etc. So actually the overall competition and competition landscape is suitable for us to actually focus and fill the gap in the market. From a secular standpoint, we are at an early stage of a sustained growth cycle, particularly in housing, which is going to be a core of our wholesale book. This vintage is characterized by demand-supply gap in favor of demand for housing, inventory levels which are at all-time lows, and high affordability of the homes. This ecosystem is also now cleaner, it's more regulated, is governed better, and therefore much better to actually do business into. And last but not least, we have new growth frontiers emerging in tier 2, tier 3 markets, where we have obviously a strong franchise building up on the retail side of our business, and it's symbiotic with what we want to do on the wholesale as well. So I'll spend a couple of minutes on the opportunity in the small developer financing business. Basically here the idea is to focus on smaller projects where the revenue potential is in the range of 150 crore, across the outskirts of tier 1 markets and tier 2 and tier 3 markets where our retail franchise has a strong presence as well. We would want to, in this strategy, lend to smaller developers who are underserved and therefore are under-levered. And therefore, the risk we are taking here is frankly much lower than it is otherwise in larger markets. And in doing so, because the competitive intensity in this segment is low, generate yields which are better. So on risk-adjusted basis, we believe that we will generate better returns and see material growth coming in this strategy. This business can offer meaningful growth, as I said, and today the annual financing need in this space is 25,000 crore, which is going to only grow from here. We also acknowledge that we do need a different skill set and different execution approach towards this business, and therefore we are building a specialist team under the leadership of Arpit, who ran similar business for another financial institution earlier. We'll actually give more as we progress on the business strategy in this space. Moving on to the CMML side of our business, it basically is a corporate middle market lending business, which, as I said, adds to diversity and granularity of the wholesale portfolio as a whole. These are basically OpCo loans given to companies with a revenue of, let's say, 100 to 1,000 crore, backed by cash flows and assets. These are not holdco financing loans, and standing in A to BBB minus end of the credit rating spectrum. Our average size also here is small, 50 odd crore, with the average tenors door-to-door being 3 to 4 years, again adding to granularity. So one theme which I would actually really highlight in execution of 2.0 part of our business is it's going to be granular, it's going to be diversified, and it's going to be managed very aggressively as it relates to the underlying asset management and risk management. Let me talk a bit about our differentiators now, and I'm going to hand over to my colleagues to take us through some of these differentiators as well. But our biggest differentiator, if you go to the next slide, we believe is the fact that we have had deep history and strong relationships in this space. We also have had valuable learnings, which we have codified into our operating models, and we have learned a lot, and therefore we think that we are better equipped to manage and build this business. But if you take a look back and see what we have done in this business for the last 10 years, we have actually extended more than 1 lakh crore of credit. That's a lot of loans that we have given out. We have contracted partnerships with more than 200 counterparties. Most of them, a vast majority of them, have performed very well for us. And therefore, we'll actually continue to do business with these counterparties. And again, geographically, we have done business in pretty large territories. So that's our biggest differentiator in my view. What we are doing in terms of the organization structure as well, and this is coming straight from some of our learnings from the past, is we are organizing ourselves in a very different way. We have re-engineered the processes, and what's at the heart of our re-engineered process is the fact that the decision-making has to be decentralized, and we need to have proper checks and balances in the system when we are looking to build such a large portfolio. And that's the reason why you would see on the right-hand side versus what we were at the left-hand side of this chart, we have separate origination, credit, asset management, and wedge boxes with independent deliverables and mandates. Work together towards the common objective, but decentralized with having proper checks and balances in the system. Similarly, the corporate function or control functions, as I call them, have separate reporting lines and acts like gatekeepers of different parameters as we build. I will now ask Khodada to actually take us through some of the other differentiators, followed by Sandeep.
Thank you, Yash, and good evening to all. In our lending business, it is really important that we do the job of contracting risk well, and once the risk is contracted, we do the job of managing the asset well. That is really what the lending business is all about. While contracting the risk, we today put all our deals through a fairly comprehensive list of boundary conditions or sandbox conditions, which you see on your left, which largely incorporate, this is a GIF that we have created, which, the one that we refer to on the left, which are basically boundary conditions or sandbox conditions, which typically incorporate some of the learnings from our past deals. These are the set of 14 conditions which each deal has to go through, and if each of the deals does not meet any of these guidelines, we actually reject those deals. So that gets reflected, and I'll again refer to the deal pipeline funnel. This again gets reflected in the acceptance ratio of our deals, of the deals which are actually originated to the deals which get disbursed in 1 in 12 deals, which reflects that today we are a little lower on that ratio and we will move up. But what we are trying to emphasize here is the stringency and the discipline with which we onboard new deals. Moving on to the asset management piece. In our perspective today, asset management is not only about monitoring deals, but today owning and managing the asset once the deal gets transferred onto the balance sheet. That's the critical difference from then and now. The core job of this team is not only to look at project progress and do the actual versus the underwriting, but more importantly to identify, highlight, and act upon the earlier warning signals to prevent a potential difficult situation. And moving to the extreme right, in case that we identify any stress deals, we have this specialist workout team or our wedge team. This is a team who has the experience and the expertise to do the heavy lifting in terms of a stress scenario. They can do the job of enforcing and take suitable action on the deal at a very early stage, and that is the reason why this team is very important. What we are essentially trying to say on this slide is the success of the platform is really dependent on what we onboard, and that is why the credit team is very important, and how we continue to manage this asset going forward, for which the wedge team and the asset management team play a very critical role. Moving on to the next slide. Over here you can see that we have a fairly robust risk management framework in place. We have a very experienced CRO in Narayan Prasad, who manages a team of risk managers who function independently of business and report directly to the risk management committee of the board. The risk framework is completely embedded in our deal cycle, right from the origination stage and the sanction stage, where the deal rating is done by the risk team, to the portfolio stage, where the stress testing is done by the risk team and reported to the risk management committee of the board. On the governance side, we have actually divided the sanctions into multiple layers. Once the deal is sanctioned by the credit team, the deal then moves over to the deal clearance committee. The deal clearance committee not only comprises of the business, the asset management and the credit team, but also personnel from risk, compliance and legal. The deal and the teams get a complete perspective on the deal and add their inputs to the deal. And only once this deal getting cleared does it move to our ECC, which is our credit approving committee, for final approval. Throughout this deal structure, we are ensuring that the deal actually goes through multiple set of eyes before it reaches the deal clearance committee for its approval. Post-investment, we have the project monitoring committee, which again meets on a quarterly basis. The key idea over here is to assess the overall health of the portfolio, and if any of the deals require any timely intervention based on the EWSs which are highlighted by the risk team or the asset management team. Sandeep, over to you.
Thank you, KP. For us, technology is at the core of the wholesale business and enables our functioning and decision-making in a digital manner. We believe it would be a strong source of competitive advantage for us in the future. There are two parts to our digital strategy. The first one is the usage of technology in our day-to-day functioning, whereby all our systems, data processes, deal managements are undertaken, right from origination to exit, are performed with a digital footprint. Towards the same, we have integrated our systems like LOS, LMS, asset management, Salesforce with specialist databases like ProVakil and PropEquity, and have enabled this data visualization through dashboards to enable our teams to take faster and better decisions. The panel on the left-hand side shows some of these dashboards that our teams use on a regular basis. The second part of our digital strategy is in the implementation of automation and machine learning to make robust data-driven decisions. This is especially utilized in the underwriting and asset management domains. We have initiated a pilot program using machine learning and artificial intelligence to undertake predictive analysis for underwriting of new deals. Basis the data that we have, the rich data that we have from about 400 past deals, we have run a decision tree algorithm that ranks different parameters, basis which new deals are evaluated on their doability or not. This pilot program is expected to gain further proficiency in the days to come. Summing it up, we look at technology as a key enabler and are embracing it extensively in the wholesale business. Moving on, let's look at how our new portfolio looks like. Although the real estate portfolio in 2.0 is relatively small, yet it is already well diversified and will diversify further as our small developer finance business grows. The book has an average ticket size of about 160 odd crores with a yield of approximately 14% and door-to-door tenure of about 4 years. Since these are amortizing loans, the effective weighted average tenures are more like 2.5 years. Moving to our corporate and mid-market book, this is diversified across 16 industries and has an even smaller average deal ticket of about 53 odd crores with a door-to-door tenure of 3 years. Going forward, we will continue to build a book similarly with granularity and a diversified approach in a disciplined manner. I would now hand over the presentation back to Yesh.
Thanks a lot, KP and Sandeep. If you can move to the next slide. So what we are really building towards, we are building towards a wholesale business of 35 to 40,000 crore by FY28, which generates an ROA of 3.5 to 4%. The ROA tree is on the right side. If we generate a NIM of 7.5%, which is where we are at today, frankly, and an OPEX of 1.2%, which is again where we are at today on our new business, it throws a PPOP of 6 to 6.5%. And then if you set aside 1.5% of credit costs and tax, that takes us to 3.5, 4%. So math is pretty straightforward. I think the objective and the challenge for us is to make sure that we actually sticking to these numbers. But we do feel good about where we are at in our evolution. We feel very good about where the market throwing opportunities and our ability to actually build a robust business, which is where we want to get to. In conclusion, As I said again, right in the beginning of my presentation, I think our objectives are pretty straightforward. Optimally run down 1.0, build a granular 2.0 to 35, 40,000 crore in next 4-5 years, build a decent 3.5-4% ROA, which will be accretive to our profitability. And along the way, we want to make sure that we are doing a good job of, on all these fronts, and monitor the growth as well as the impact on the P&L as we go. With that, I'll actually end my presentation. Thank you so much for your attention, and I'll invite Kalpesh to talk about his speech. Thank you.